My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. Other people want to make friends? I'm just trying to make you a little money. My job is not just to entertain, but to educate. Figure out how days like today could happen. So call me, 1-800-743-CBC, or tweet me at Jim Cramer. You know why I love the stock market? I mean, adore it. Because of days like today, where the Dow surged 527 points, the S&P soared 1.49%, and the NASDAQ pulverized 1.54%. Buy! Just 2 days ago, we were filled with despair. It seemed like everyone on Wall Street figured there'd be no Santa Claus rally this year. The general consensus was that Fed Chief Jay Powell is a total buffoon. They know nothing! He raised rates too fast in 2018, then had to immediately change course right after now. It's kind of right about now, right around Christmas time. He took rates too low in 2020, then he took too long to raise them again this year. Big-time strategists keep coming on air to slaughter the pathetic bulls. Trapped in a ring to be teased and killed for the benefit of a charged-up audience. According to conventional wisdom, there was just no way out. Either Powell would tighten too hard and destroy the economy, or he'd tighten too little, allowing inflation to persist and destroying our collective purchasing power. Had to be one or the other. At the same time, we were terrified that so much inflation refused to go down, especially wage inflation, that the Fed was trying to crush us by crushing wage inflation. It's the only way they knew how to do it. I guess you could say it was totally hopeless. To quote those economic titans, McFadden and Whitehead, in their seminal treatise on prices, ain't no stopping us now, we're on the move. And then it all changes. Like a spell has come over the market, and we're suddenly in New Orleans saying, laissez les bon temps rouler. And the good times are rolling for something the bears don't even want to acknowledge. Excellent quarters from two high-profile companies that were supposed to stink up the joint, Nike and FedEx. Technically, only Nike had a good quarter. FedEx had a better quarter than was better. Let's say a quarter was better than feared, but that's all that mattered. Nike's last few quarters were dreadful, largely because there was too much inventory and not enough shoppers, especially in China, which is a big part of the business. This time, inventory was down, which benefited the Chinese biz immensely. Sales up a surprising 6%, while Europe was good and, of course, America great. This was the reliable Nike of old, just when we thought those days were over. But now Nike's back, and the future's looking brighter, with China finally dropping its nonsensical zero-COVID policy. That's how a big-cap stock jumps 12% in a single day. For a bull, though, FedEx was even better. Long before the shipping business fell off a cliff this year, FedEx was known for endless revenue growth with constantly disappointing earnings. But now it's got a new CEO, Raj Subramanian, who's doing the opposite. Okay, missing the sales forecast, but crushing the earnings estimates with the promise of more cost cuts until FedEx gets to the point where they probably try to turn a profit on every single package. And that is a tall proverbial order. But the company's headed in the direction Wall Street wants, a pleasant surprise given the overall weakness in the freight business. Now let's step back for a second and focus on what's really happened today. Something that I teach every day in my 10:20 a.m. morning meeting for the CNBC Investing Club, of course, as well as our bulletins. You got a whole contingent of professional commentators and money managers who act like nothing matters beyond statements from the Fed and the price levels of the S&P 500. See, they're dead wrong, but that mentally explains why so few of them saw today's rebound coming. So let's go over what happened here. First, even if you only care about the Fed, it's not like we get news from these Fed officials every day. The stock market has the memory, of a mayfly. So we can't just ruminate on what Jay Powell's up to or how Christine Lagarde, the head of the European Central Bank, is calling for a bunch of 50 basis points rate hikes as she did at the end of last week. That seems like ages ago. The brain doesn't work like that down here. If something's negative and it happened on a Monday, like a blast the industrials call by David Costin over at Goldman Sachs, great guy, very smart, or the Titanic two-part broadside of bearishness from Mike Wilson at Morgan Stanley, those calls mean nothing by Wednesday. Not here. That's not how it works around here. It's just not how it works. Those calls were already baked in. They were baked in by yesterday. Second, and more important, are the levels these bears keep calling for. I don't want to be too disparaging, but to counteract their negativity, we ran a special off the charts on Monday with legendary market historian Larry Williams. I don't know if you remember that, but he demonstrated that historically speaking, the market almost always starts going up around December 22nd. Well, when is that? That's tomorrow. His conclusion? Santa Claus is coming to town. Now, I went to him today to explain the earlier arrival. I mean, come on, when Santa was here. Thinking maybe Santa wanted to get ahead of the bomb cyclone, a weather term created to generate better cable ratings. Nope, he said, Larry, he said, Larry, and he sent me this chart. It's tough to be a day early and a day short. This year, it was a day early and a day to be long. He also told me it could be Santa Prime getting a jump on brick and mortar retailers. See where this is? Right? Where were the strategists? How come they didn't have this? I don't know. You see, while I'm not always a huge believer in the charts, the fact is there really are patterns that hold up under close scrutiny, and few of them are more reliable than the Santa Claus rally. Maybe it's the end of tax law selling. Maybe it's people making one last contribution to their 401k or IRA before the year ends. Maybe it's because the gloom is temporarily lifted, like some sort of weird stock market Christmas carol where a bear Scrooge gets religion and embraces the bull. In the end, we don't know why these patterns repeat, okay? We really don't. But we do know it happens almost every year. At the same time, the thing I hate most about these top-down strategists is their insistence that the only thing that really matters is the S&P 500, and that's just one giant bushel of stocks controlled by a pack of bonds. Now, I'm riffing on that song from Guys and Dolls because I got cut from it at high school. The drama teacher didn't like me, in part because of the girl I was dating, I think, at the same time. It had nothing to do with my singing voice. All right, back on topic. Stocks are not just bushels of wheat or bales of hay or any other kind of grain varietal. They are huge differences between individual companies. John Donahoe, CEO of Nike, Raj Subramaniam, CEO of FedEx, aren't strands of hay that could be swapped out for any other executive. You see, they're real humans who have rallied the troops and come up with better than expected numbers. Let me put it another way. We don't trade the NFL, right? We follow individual teams. When a team gets a new coach, like the formerly awful Giants, and replace him with a brilliant everyman like Coach Dable, only to become excellent almost immediately with the same cast of characters, we accept that leadership matters. But you don't need to know the overall level of NFL play. That's meaningless. Same goes for the overall level of the S&P 500. It's much less relevant than identifying the stocks of companies that are poised to put up stronger numbers. Now the Santa Claus rally may be here today and gone tomorrow, although Larry Williams statistics say that's unlikely. What matters, though, is this wonderful, magical thing we call the market can resist the sirens of negativity and just get it done like any underdog can. No, it's not any given Sunday, and not just because it's a Wednesday. But at the bottom line, as much as the overall situation can lend itself to despair after a year in bearish territory, perhaps there are term limits to the bear market, even if it's just a brutal interregnum between unhappy grizzlies in Jellystone National Park. Let's take questions. Let's go to Tyler in California. Tyler.
Hey, Jim. Big booyah from California. How are you doing today?
I'm doing well. How about you, Tyler?
I'm doing great. I'll keep it real quick for you. What do you think of Salesforce, CRM?
All right. Now, for the Charitable Trust today, we bought some. We sent out, Jeff Marks and I sent out, I think, a terrific letter just saying, you know what, we sold some much higher. It's okay at this point. Not great. We don't expect blowout numbers. But we do think that in the end, this company's worth more than it's currently selling. All right, on Mad Money tonight, we're taking a closer look at this year's horrible performance in the technology sector, revealing a few ideas. I think they could do pretty well in 2023. Then PG&E is on a mission to recreate their business and make it stronger for the future. And I'm learning more about where they stand with the company's top brass. And how does the real estate sector fare in 2022? I'm taking a closer look at the cohort and seeing if next year could be a winner for a handful of names. So stay with Cramer.
Don't miss a second of Mad Money. Follow @JimCramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call. at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.